Okay, so Nike just turned in what looks like a massive profit beat. Like, profits basically doubled. But if you actually peel back the curtain, it wasn't driven by selling sneakers. It was fueled by a $986 million check from a Supreme Court tariff ruling. Welcome to Earnings Unscripted, by the way. It is June 30th, 2026, and we are unpacking Nike's Q4, ticker NKE. And before we get into the boardroom drama, just a quick reminder that this is all just our personal opinion, not financial advice. So please don't make any trades based on our banter.
No, definitely not. But honestly, their legal department is the real MVP this quarter, because when you strip away that tariff money, the operating picture is completely different.
Completely, because top-line revenue actually fell. It came in at $11 billion flat this time, down about 3% from the $11.3 we saw last quarter.
Right. The headline diluted EPS was 72 cents, which looks amazing compared to the 35 last quarter. But you take out that one-time windfall, and the adjusted EPS is literally 20 cents. It is basically a phantom profit.
Yeah. And it totally warped the margins, too. Gross margin shot up to 49.2%. And if you didn't read the footnotes, you'd think they magically fixed the supply chain.
Exactly. I mean, without that legal check, gross margin was completely flat at 40.2%, same as Q3. Operating income looked like it doubled to over $1.3 billion, but the core retail engine is essentially just stalling, which, to be fair, explains the after-hours tape.
Oh, man, the tape. So the stock had already bled out almost 23% over the broader quarter, just a steady grind downward. Then the earnings hit and it just fell off a cliff in extended hours. It plunged down to $37 before the call even started.
Right, because the algorithms and institutional money saw the low quality of the beat immediately.
Yeah, exactly. But then it recovered to around 40 once the management team started talking, probably because the actual turnaround strategy is, well, it's pretty aggressive. I mean, they are taking a machete to their own sales.
The European digital purge. Yeah, that was probably the most telling part of the whole report. EMEA digital sales plummeted 24% year over year. And management is just proudly saying, yes, we did that. We deliberately chopped the off-price promotional business in half to repair the brand cachet.
It is a massive risk. I mean, they are actively choosing scarcity over volume. Elliot Hill actually pointed out Serena Williams today on the call. She was just casually wearing their new Radical Air product. It feels like they're trying to rebuild that authentic, organic, cultural relevance instead of just shoving discounted inventory down the digital pipeline.
It is a necessary reset, but the timing is really precarious. You have sportswear declining double digits, the running segment is kind of single-handedly keeping the revenue afloat, and now the CFO is leaving.
Wait. Matt Friend is out?
Nearly 18 years with the company. Yeah, he's stepping down right in the middle of a massive restructure.
Wow. Changing the financial pilot during severe turbulence. All right, let's get into the details on this intentional product wipeout and how they're planning to survive the transition.
It is honestly wild to watch in real time. They basically put $2 billion of classic inventory into a figurative incinerator, just completely pulled it out of the market for fiscal 2026.
That is an astronomical amount of product to just vanish on purpose. I mean, what exactly falls under classic franchises here? Are we talking Jordans?
Jordans, Air Force Ones, all the legacy cash cows, the stuff that built the premium aura in the first place. The problem is they flooded the zone over the last 3 or 4 years. Everyone has a pair now, so nobody actually feels like they need a pair. They traded exclusivity for pure volume.
Which works beautifully right up until it suddenly does not.
Right, until the brand fatigue sets in. And Elliot Hill, the CEO, actually admitted this on the call. He said, "We have taken $2 billion out of the market in FY 2026 of our classic franchises." He phrased it like a strategic victory, but really it is an admission of past mismanagement. It means they saturated the market, broke the halo effect, and now they're actively starving the ecosystem to force the demand curve back up.
That is such a brutally expensive lesson in brand psychology. You cannot just tell consumers a shoe is cool. You have to make it legitimately hard to get.
Exactly.
But what really fascinates me is the other half of the strategy. They're pulling back supply on the classics, sure, but they're also openly crawling back to the wholesale partners they dumped a few years ago.
Yes, the Foot Locker apology tour.
Literally, because 4 years ago, Nike was telling the market they did not need multi-brand retail. They were going to be direct-to-consumer purists. You buy it on the Nike app or you do not buy it. And now they're practically throwing a parade on this call because they saw positive revenue at Foot Locker.
Well, it is amazing how a 23% stock bleed makes you appreciate shelf space again. Look, the arrogance of the D2C pivot finally caught up with them. If a kid wants to walk into a mall, compare 3 different brands on a physical wall, and then make a choice, you have to actually be on that wall. You cannot just mandate that they download your app to pad your corporate margins.
People shop where they want to shop. The ecosystem wins every time.
It always does. And honestly, it is not just the U.S. wholesale market where they are unlearning things. They are having to rewrite the playbook in Greater China right now, too.
Greater China was down 20% sequentially this quarter, right?
Down 20% quarter over quarter and down 17% year over year. Absolute cratering of market share. For years, Nike just relied on global silhouettes there. Sell the exact same shoe in Beijing that you sell in Chicago. But now, local Chinese competitors are eating them alive on speed and cultural relevance. So management is finally shifting to a hyper-localized design model.
I think they called it local for local product creation on the call, but that is not even slated to launch until holiday 2027, which feels incredibly far away when you're losing nearly a fifth of your revenue year over year. What's the stopgap until then?
There is no stopgap. That's why they're hoarding cash right now. Nike only repurchased $123 million in stock for the entire year of 2026. For a company this size, that's a rounding error. They essentially paused their $18 billion buyback program.
Okay, so that signals real caution. They know the turnaround is going to be incredibly capital intensive, and they're prioritizing internal operations over propping up the float.
Completely. Elliot Hill made this whole lengthy analogy on the call about the New York Knicks winning their first NBA championship, talking about grinding through double-digit deficits and making unglamorous hustle plays. Listen, he literally said, "The real story is never just the celebration. The real story is everything it took to get there," which is basically CEO translation for, "We're in the very ugly phase of the rebuild. Please do not fire me before it works."
The unglamorous hustle phase. Well, they are certainly hustling backwards to fix the mistakes of the D2C era. I guess the big question now is whether Wall Street has the patience for this kind of multi-year grinding strategy. Because looking at that forward guidance, things might actually get worse before they get better.
Well, it leaves them staring at a pretty bleak back half of the year. The guidance for the next 3 quarters is... Look, it is not great. They downgraded expectations to be down low to mid-single digits. And Matt Friend actually went out and said, "We are not expecting the environment to improve meaningfully over the next 6 months."
Okay, so that is interesting because deliberately withholding classic sneakers, that is a conscious strategy. But calling out the broader environment, that feels like admitting you do not completely control the landing.
Exactly, and that is exactly why they're sitting on $9 billion in cash and entirely pausing their share buybacks. I mean, they bought back roughly 123 million in stock all year. For Nike, that is literally just rounding error money.
Right, so they are stockpiling capital because whoever steps into that CFO role next is going to need every dollar.
Absolutely, and the second quarter is going to be really incredibly challenging. Friend basically gave an early apology for it on the call, citing a bunch of comparative anomalies from last year's wholesale timing. They're desperately trying to get investors to look past the immediate future.
But, Mara, we should probably give them a little credit here. They easily could have taken a massive victory lap on that $1 billion Supreme Court windfall to pretend everything was fine. But they didn't. They acknowledged the reality. They are actively taking pain to repair their brand cachet.
I completely agree. It takes real discipline to just burn the ships like they did with the European off-price business. If this hyper-localized push in China and the focus on exclusivity works, they come out much stronger. But the near term is just, well, it's going to test everyone's patience.
So basically they're asking Wall Street for a multi-year grace period. Good luck with that.
Yeah, good luck.
All right, let's see if the swoosh can actually pull this turnaround off. That wraps our look at Nike for the quarter. Thanks for thinking out loud with us, everybody. Catch you after the next call.
See you next time.
So if you want these unscripted chats to just quietly show up in your feed, feel free to follow the show. Just a quick transparency note, we do use AI tools to help create these episodes, mostly to read through those massive 100-page SEC filings so we can actually focus on the story. We'd love your feedback, so if there's a specific ticker you want us to look at, shoot an email to earningsunscripted@datamadness.ca or find the X link in the show notes.
Take care, everyone.